This is the video that gives some insight into how our traders actually create their reports. First of all, just to describe the template as it stands at present. We normally have the date at the top here, what currency we're looking at or market we're looking at, and the reference price. Obviously for futures markets it would typically be the close, but for FX then it is important to say at what price the report was actually done. The picture on this side here highlights the supports and resistances at the bottom of the report and gives a graphical representation via the horizontal line about the accuracy of any of those levels. So we don't pretend that when we got it wrong, conveniently forget about it, and when we're right we don't sing our praises from the rafters. So there's a very easy way, if you look at past reports, to see how accurate they actually are. On the left hand side underneath key points there'll be a comment about the market. Can be quite long. In this case it's actually quite short because there wasn't a great deal going on in dollar yen. And then for the foreign exchange markets there's specific buy or sell recommendations, or how the current positions are actually being managed in terms of what the size of the position should be. The supports and resistances are down the bottom here, and then on the FX report we say what the major, intermediate and short-term trend are. On the futures markets then we say we put actual levels in there. If the market is overbought or oversold on a time frame above 60 minutes on foreign exchange, then we will say what that's happening. And that overbought or oversold indicator is quite often shown on the chart as a KPO. In how we create the reports, there's actually really, by and large, just four major methodologies that we're using. The first thing is true measurements of support and resistance, and that is done via market profile, and that is the basis of the entire report. What we are doing there is giving traders, whatever their time horizon, if it's very short term or if they're strategic traders, we're giving them the framework of the market and saying these are the areas or levels where your concentration should be heightened and where you should think about managing whatever positions you're getting involved in. The next is true measurements of overbought and oversold, and this uses a study by a lady called Cynthia Case, and it's called the Case Peak Oscillator. You can get a lot of information from her website, which is either statware.com or you've got caseco.com. That's K-A-S-E. We also look at limits of range and the trend of the day via what's called range deviation pivots. They are not necessarily put in the report itself, but for people who subscribe to my studies on the CQG system, they can get those levels on the daily charts. They can use them on intraday basis as well. What that is trying to do is connect limits of range, or understand what the dominant trend is, and use it either as pyramid points for trend following or for contra trades associated with those supports and resistances. And we're going to look at an example last week that occurred on the British pound. Finally, we have limits of range and trend for the specific time of day. Again, you need the software to actually be using this, but this is another very powerful tool that traders use to connect support and resistance together. Effectively, if we add a support or resistance and it's the limit of range on, say, a 60-minute chart for that time of day, you should be hitting the market with a lot more volume, or you should always be active. We don't normally show market profile charts on the reports purely because they don't look particularly good on such a small A4 piece of paper, and we like to be very transparent about the accuracy of our reports via those horizontal lines on a normal chart. However, while we do keep some of our methodologies proprietary to ourselves, it's fair to say that we, on the basic level, there's nothing to say that for people who have access to market profile, that you cannot create a lot of the distributions and the supports and resistances for yourself. There really is just three main rules that we use. If the current trend is up, then resistances are created via the market profile distribution of the previous trend, which would have been down. Supports are created from the current trend, and then we use the current 5-day profile to give our idea of the short-term levels that are really more relevant to the very short-term trader or day trader, somebody who's maybe only looking to hold a position for maybe minutes or even just a couple of hours. In terms of the terminology that we actually use, those minor levels will always be flagged, but where there's major levels, then we will say so as well. And those major levels tend to be just 2 or 3 different things. We would reference what we call a distribution low or distribution high, and a distribution low would be something like here, whereby the market has then formed a bell curve, as it were, at this point. We would also reference what we call vacuums, and vacuums are area where we spend very little amount of time, and so a vacuum point will have a high and a low. And then we reference what's called the control point, or the longest line, which is where we have the most amount of time. Effectively, the commentaries are what I would say 80% science and 20% art. So there is still the human element, as it were, how we actually come to the conclusions of our analysis. So while you will be able to replicate a great deal of the levels that we come up with, there's still an element of the experience that we've had, or I've had over the last 25 years of using Market Profile, where there'll be times where I think that some levels have more significance than others. Now we're going to look at an example of how the report could come together to provide what was a very low risk entry point on the British pound. It was back on the 13th of February. And the first thing to look for is the recommendation. The first part just says that we were a buyer down at 142.92 and 42.02. But the key thing was that the aggressive short players, on a failure of the S&P at 840, could sell the pound up to 146.16. There is a correlation at the moment between the S&P and the pound against the dollar. So what had happened was the 840 point on the S&P was the control point. So this is the flip point between bullishness and bearishness. So if we came up to control, then looking for a failure there, if that coincided especially with the pound coming up to its major resistance that was at 145.80 to 146.16, we had the connection of 2 different markets coming together from the point of view of supports and resistances. Now, as it turned out, it also connected with those other studies, which meant that you would have been able to hit it with a lot more volume. Now I'm just showing you what the market profile looked like on that trading day, and the reason why we had 145.80 to 46.16 was to do with this area here. So it was a point whereby we have a relatively static amount of time, but this is when time really starts kicking in into this distribution, the belly of the distribution here. So when the market was coming up to this level, this would be a very powerful resistance point.